Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Economic growth continues to struggle despite various government measures to revive it. Most growth indicators, including corporate earnings growth projections, have been anemic, with little sign of any significant pickup in the near term. Headline CPI inflation had surprised on the downside, although core inflation was still stubbornly high above the 5% level. Globally, sentiment remains fragile, although the past month has seen a revival in risk appetite across global markets and most commodities. The government had surprised most street expectations by delivering on its promise of fiscal prudence in the budget, as required by the RBI, and also sharply reducing the small savings rate, which was quite surprising given the magnitude of that move, so that banks could transmit rate cuts more easily to the market. Domestic liquidity conditions had tightened significantly over the past few months, with the liquidity deficit shooting up to about 2.5 lakh crores, leading to banks complaining about tight liquidity conditions despite the various rate cuts by the RBI. Markets, equities and bond markets had rallied quite significantly over the past month, aided by increasing expectations of RBI accommodation. While a 25 basis point cut was fully priced in, many market participants had started hoping for a 50 basis point cut as well. Hence, the bar for expectations was quite high before the policy. In today's policy, RBI cut policy rates by 25 basis points, with the benchmark repo rate being cut to 6.5% from 6.75% earlier. But more significantly, various other liquidity positive measures were also announced. First, the policy rate corridor was narrowed from a band of 100 basis points to 50 basis points. What this means is that banks can borrow from RBI under a penal MSF rate at 7% instead of 7.5% as per the earlier bands, and banks can lend their surplus funds to the RBI at 6% instead of a penal 5.5% earlier. The second important move is a move from the ex-ante liquidity deficit of 1% to a position closer to neutrality. This is indeed a very significant change by the RBI. Apart from this, a few other liquidity aiding measures were also announced to ease this tight liquidity situation. The RBI also indicated that the stance of monetary policy going forward would remain accommodative, responding as and when space for further easing opens up. Finally, to emphasize on the liquidity stance, the RBI concurrently announced an open market operation of 15,000 crores for April 7th. While the rate cut of only 25 basis points did disappoint bond markets, and even more so the equity markets, we believe the policy measures were quite justified, and it's more a case of market expectations getting ahead of themselves. In fact, a big positive we believe was that while RBI cut rates only by 25 basis points, they have announced very significant changes and improvements to the liquidity framework, which are in many ways more helpful than the extra 25 basis points that the market was hoping for. Especially the move from a 1% deficit target to a neutral liquidity target would mean that the RBI would be much more proactive with ensuring that durable liquidity, either through US dollar purchases or through open market operations purchases, is increased in a significant way over the next few quarters to gradually eliminate the large liquidity deficit currently in the system. Over the past 6 months, the market's main worry has been the demand-supply mismatch in the government bond market, which had pushed yields higher over the first 2 months of the year. This, to a large extent, should get corrected, with markets now comfortably factoring in that the RBI would absorb a significant amount of net supply of government securities through their open market operations through the course of this year. Short-end liquidity conditions should improve as well, as the government starts to spend more, and also with the RBI proactively ensuring adequate liquidity. Lastly, we believe that the RBI is unlikely to cut rates further over the next 4 to 6 months, till the full outturn of the monsoon is known and food inflation moves down sustainably and significantly versus expectations. If indeed inflation surprises again on the downside, then maybe room for a further 25 basis points cut in the second half of this year may open up. Equity markets clearly responded quite negatively, with various indices down more than 2% on the day. This is partly on account of course, the global cues today, but also due to the disappointment that RBI did not cut 50 basis points as expected. Bond markets swung widely through the day, with the initial post-policy move being one of exuberance, with yields down sharply. But later on, these gains were given up and bond markets ended in the red. The 10-year benchmark government bond yield ended higher by 4 to 5 basis points on the day. At the shorter end, while 2 to 3 month bank certificates of deposit yields are lower by about 10 basis points, and the 1-year CD rates are actually up 5 basis points. Corporate bond levels are also trading flat to higher in yield terms. We believe the policy announced by the RBI today is the right one and appropriate given the current needs of the market. While expectations were quite high and hence the disappointing reaction post-policy, from a medium-term perspective, we believe that the positives outweigh the negatives. Notwithstanding some more market correction over the next few days, we continue to expect yields to move lower as the RBI's open market operations become a more regular feature of the demand-supply equation for government's bonds. Given that we don't expect much more space for policy rate cuts going forward, the extent of gains, however, is likely to be limited, possibly another 25 to 30 basis points from the current levels in terms of yields moving lower. However, short-end rates can move lower quite significantly over the next few weeks as the liquidity situation eases and funds flow back into mutual funds and the chase for assets resume. Accordingly, we believe for shorter time horizons, ultra short-term funds and short-term funds could do well, and over 3 to 5 year horizons, yield-oriented accrual funds could outperform. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund Family.